number 1 under advanced financial management. If you remember the topics we already listed, capital budgeting was the first one. We started, and I believe you are able to see my screen before we even start again. So as you are able to see my screen, you're able to remember and remind yourself of the insights that we gave concerning these topics in advanced financial management. And we looked at topic number 1. We started by advanced capital budgeting. And in advanced capital budgeting, we gave a description or a definition that is very easy to understand. And we chose the best and the easiest possible words. And we said that capital budgeting involves employment or commitment of funds in long-term projects, and you expect the yield or the returns to be in the future. So that is the simplest definition. And from that definition itself, we are picking two major elements. We are picking commitment of funds in long-term projects. And again, we are picking that returns or the yield is coming back to you, or as an investor, your return is in the future. It is not instant. So those already advised us to give the first two elements or characteristics or features of these capital budgeting projects. I believe you remember we started with the first two that we already can pick from the definition, which I've given there. And we also added on to others, which I believe we also still understand. Now, I'm just brushing through for the sake of those students who are not able to get to see the first and the second classes, because this should be the third class. And if you missed them, I want to encourage you and to advise you that you go to the profile, dig through and get through the videos of the first two classes so that you don't miss out and you get to catch those simple concepts we discussed, because we looked at them in details. Now, I'm just reminding you of major areas that you need to look at. Now, as we continue, you remember I said that we are picking the first two elements from the definition, which I said long-term investments and then the returns are in the future. Those form the first two elements, and then we added some other characteristics or some other features where we said that these investments or these capital budgeting projects involve huge capital outlay. So the capital that we invest is quite a bit. That is another feature. And then we also know that where you involve a lot of funds, risks are also imminent. So we also have another element or a characteristic that says that these projects, capital budgeting projects, are risky in nature. Then we also bring on board another element where we are saying, because you involve a lot of capital outlay, and again, the returns are long-term, and these projects, because they're capital intensive, and once you do your investment or you already employ the use of your resources to invest in these projects, it is not easy to reverse. So they are not reversible, they are irreversible. We went ahead and looked at the types of capital budgeting projects, and one of them was mutually exclusive projects. I gave you examples that you can relate with, and I said that mutually exclusive projects are projects that are competing for the same resources. They're projects serving the same purpose. And if you choose one of those two projects, or three or four, depending on the number, if you choose one project, the other one will automatically be disqualified or abandoned. I gave you an example of a school that wants to buy a school bus. They have a choice to buy two different brands. I'm assuming brand A and brand B. So if you choose to buy brand A, then that means you'll automatically abandon brand B. So those two projects, these are mutually exclusive. You invest in one, automatically it cancels out the other. So because they serve the same purpose, you only have to make one choice out of the two. We went to the next type of capital budgeting projects, and we looked at independent projects. And I told you, because from the term independent, it simply means these projects are serving different purposes. And the choice to invest in any of those two projects, if you have to make that choice, will depend on availability of resources. They do not interfere with each other. They are very much independent. Availability of resources will dictate whether you are investing in project A or project B or project C, like that. Then, when we mention independent projects, then remember, dependent projects also come into play. Now, what are these dependent projects? Dependent projects are projects that now depend on each other. Investment in one of these projects automatically will call for investment in the other project. I want to use the same example I used in the mutually exclusive projects, and I want to use the example of a school bus. If a school buys a school bus, they have a project to have a school bus. They've already given their choice and they've already settled on which one to buy. Now, they've already even agreed on the brand. Now, once they buy this school bus, remember, the project is school bus. This bus will not drive itself. They have to also engage a driver. Now, Engaging a driver was not their initial project, but now, because of this first project of bringing on board the school bus, they will now have the need to bring on board the driver, which is now a different project. So these two projects are dependent projects. One project depends on the other to function or to achieve the purpose at the end of the day. So that is the clear definition, and that is, that is a very good example that you can easily relate on so that you don't forget. Now, we also went and discussed divisible projects, and I gave you another good example that you can always remember. And I said that divisible projects are projects that will be able to give you returns even before you complete them. An example case in point is rental house. Whenever you're building a rental house or putting up a rental house investment, those completed units can always be occupied by by tenants. You will always start selling off the completed units even before the whole project is completed. Already, whenever tenants come on board, they will start paying you. Already, you are realizing returns before the project is completed. That type of a project is called divisible project. Again, another example which I gave is professional courses. For example, a student who is pursuing CPA might be able to get employed or secure job at CPA level 2, for example. Now, you've not finished the project. You are still way far. You're already into the project, but you're not yet completed. But already it is giving you returns. You are able to get returns from that investment or that project even before you finish. Already, now that type of a project also falls under the category of divisible projects. Now, what is the opposite of divisible? These are indivisible projects. Now, these are these projects that do not start giving you returns before you complete. You have to complete them so that you get your returns. Yeah. So these are projects that you have to complete. For example, if you are maybe undertaking a project of motor vehicle assembly, for example. Now, when you want to assemble a certain brand or a certain type of motor vehicle, you will not expect that it will start giving you returns before you complete. You have to do it to completion so that you sell a full completed unit so that you get your returns. That kind of a project is indivisible. You have to finish for you to start gaining or realizing returns from it. Now, that is just brush over, just giving you an overview of what we already discussed. I want to encourage you to go through those videos. I know I'm going very fast because we had covered these things before. I'm just reminding that person who is seeing this for the first time so that you catch up and you be at par. Very good. Now, we went and asked ourselves, now that we've understood the definition of capital budgeting, we've already known what are these type of projects under capital budgeting. We've already known the features of the characteristics. Now we ask ourselves, I gave you a first example of mutually exclusive projects where a school is to make a decision whether to engage brand A or brand B in their choice of the school bus. But now, what techniques do you use to evaluate these projects? Remember, you might have a range of projects, for example, 3 or 4 or 5 or even 10 of projects, potential projects that you can invest in. Now, you need to be able to evaluate these projects and pick the best one. And as an investor, you are picking that project that will either give you the best returns or you will realize your returns within the shortest period possible. Now, because your argument is on the returns, you are looking at the viability of these projects. You have to perform an appraisal of these projects. You have to evaluate these projects. And from there, you are able to rank. This one ranks the first, the second, the third. Now, that now brings us to some very critical element asking us, what are the features or the characteristics or the considerations that you make to qualify an evaluation technique as the best? But before we go to looking at these techniques and choosing which one is best, I want us to look at these evaluation techniques. We have two broad categories of project evaluation techniques. We have non-discounting techniques, and then we have discounting techniques. Now, non-discounting techniques are those techniques that do not take into consideration time value of money. We had discussed that. An example of non-discounting techniques is payback period. Now, payback period is the period it takes a project to give you back your investment. That payback period evaluation technique do not take into account time value of money. It just asks you, how long will it take this project to give me back or to recoup my investment? It does not take care of time. It does not consider that. Another type of non-discounting technique is accounting rate of return. Now, accounting rate of return is non-discounting, and it is an evaluation technique that relies heavily on the accounting profits. You see how the accounting reports are normally presented? Now, from that income statement, the profits that are given there is a technique you can use that profit to evaluate whether a project is viable or not. That is also an undiscounting technique because it does not take care of time. It does not take care of time, value of money. Now, we have this other category of project evaluation techniques that now will take care of time, and we call them discounting techniques. And now, as a finance student, you are well aware and you know that time affects the value of money. Value of money today will be different from value of money in the future or tomorrow, right? I believe so. I believe we are together in that. Now, because of that, we have to rely on an evaluation technique that takes care of time value of money. And remember, I started by mentioning what are those specific features or specific characteristics that will qualify a technique to be best fit to evaluate a project. Get that? And I've already given you 1 point. One of the features that you look at for you to qualify a technique to be the best in evaluating a project is it needs to take care of time value of money. It needs to take care of time value of money. Then another feature or characteristic that will qualify a project that we already talked about, it should give you a clear indication. It will have parameters of measuring so that you get to know that this project we can accept or reject given a certain parameters. We are going to look at them when we go to the practical aspect. Then remember, I've just mentioned that non-discounting techniques, one of them was accounting rate of return. Now, because this accounting rate of return picks the accounting profits, whenever you want to settle on the best project evaluation or appraisal technique, it should not be using accounting profits to do evaluation. Instead, it should use cash flows. Remember, when looking at a project, as an investor, your interest is on the returns. Returns go with cash flow. What type of cash flow or what cash flow are you expecting back? So this method that you want to use to evaluate these projects should be able to use cash flows instead of accounting profits. Now, even as I look at the characteristics, we are looking at the characteristics of the best fit technique, but again, we are looking at the techniques themselves. I've already mentioned to you the non-discounting techniques. 1, payback period. 2, accounting rate of return. I believe I've also mentioned what is payback period. It is the period it takes a project to recover your investment, right? Accounting rate of return is an evaluation technique that looks at the profitability of a project and compares and gives you an evaluation comparing 2 or more projects. And this one picks its figures from income statement. Now, discounting techniques, one of the discounting techniques that I would want us to look at is now discounted payback period. Now, when you talk about discounted payback period, what do we mean? We are still talking about payback period, but now the cash flows that we are using to gauge the point at which we are going to recover our investment, we are using discounted cash flows. We don't use the cash flows plainly the way they are given. We are now discounting them further. Whenever you discount, you are going to take care of the effect of time. Time value of money is being taken care of at that point. Now, as a finance student, I want to remind you and I want to take you back to make sure that you remember how you computed present value and how you computed future value. Now, when we talk about present value, you already have a future figure and now you are required to discount it back so that you get the current value, right? Now, that is computation of present value. You use discounting. And when we look at the factors, discounting factors, you talk about discounting factors, it is 1 plus r raised to negative n. I believe as a finance student, you remember that technique very well. And in fact, we already discussed it in the previous class, and I'm seeing we already wrote it even here. So you can look at my screen and you see discounting is 1 plus r raised to negative n. That is the discounting factor. Then, whenever you want to compound, your interest is to get a future value. You are compounding from a current figure so that you get to see the future one. Now, you use that future value interest factor, which is 1 plus r raised to n. Remember, when discounting, the n is negative. N represents the period or the number of years. And then when you are compounding, that n, which you raise on top of the bracket after 1 plus r, close bracket, then you raise n, that n, when you are compounding, you do not include a negative, it is positive. When discounting, then now that n raised to negative, make sure that n is negative. Very good. Now, discounted payback period is very interesting, and I want us to look at the practical aspect of it. But before we do that, let us get to cover and see what are some other discounting techniques that we are going to look at step by step. And remember, Practically, we're going to look at questions, past paper questions in the same areas, and we're going to discuss them and see how do you go about them whenever you meet them in an exam room, and how do you get to apply them in real life scenario when you are required to do project evaluation. Because as a finance student, we get out there, you have projects that are viable. Remember, you work in a company, the board is there, or the management is there, the team is there, everyone is bringing their proposals on what projects you can invest in. How will you convince them, or what techniques are you going to pick so that you prove to them that actually we should pick this project A and leave this project B? You do not just do guesswork. You use some analytical techniques, and that's what we are learning here. So that's why I normally say this content is just not relevant to CPA students, those students who are pursuing CPA. But I can tell you, even if you're pursuing your master's, your MBA, you remember that the topics as I listed, the coverage, you realize that even in your syllabus coverage, under MBA course, the master's in business administration, you're covering this. So this content also helpful to you. Even those students who are pursuing masters in finance, this is very useful to you. Again, if you're doing undergraduate course in either finance or accounting, this content, I believe you can relate with it very well. And so please welcome, let us learn it together because it is helpful and it is in your line of operation. It will be useful to you now or in the future, or already you've already covered it. Very good. Now, we look at some other discounting techniques that we've not talked about. And another one is modified internal rate of return. We have profitability index, which we are going to cover. Then we also talked about net present value, NPV, a very, very interesting, project evaluation technique. Very interesting. And it is a very, very notorious area for examinations. And we are going to see in details how, in what aspects are questions normally coming, and how will it even help you in real life evaluation of a project. You do not just wake up and start investing in a project. What are the parameters? What do you look at? And how do you gauge? We're going to look at that. Very nice. Then the fifth discounting technique, which we already discussed and we looked at, is internal rate of return. Now, to help us get this into perspective and understand it best, we already gave an example. I gave you an example of this discounted payback period, and this is just a recap of what we already did. So I'm just doing this for the sake of those students who missed this session, but I can promise you that it is something which is very simple. Now, we looked at a past paper question under advanced financial management in the CPA course, and the paper was done in May 2014, question number 2. And now just hold on a bit. Even if you don't have the question, do not worry, because I'm pulling my screen down and putting up that question right away there. Right away. You should be able to see it in a short while. There you go. So confirm, I believe you are able to see that screen. Now, this is a 2014 paper, and it was an AFM paper, question number 2, and part A was about theory, where you are being asked, in the context of behavioral finance, explain Festinger's theory of financial cognitive dissonance. Interesting one. Huh? But today, because we are looking at discounted payback period, I want us to look at part B. We already looked at it, but I'm just reminding those students who did not join the session and missed this class, because it is very interesting. Now, I will read the question very fast and go through what we already did so that you get to understand the flow. Now, Madara Limited is considering investing in one of the two mutually exclusive projects. Full stop. Now, when we mention mutually exclusive projects, we already covered it as one of the types of capital budgeting projects. Now, mutually exclusive, these are projects that are competing for the resources. These are projects that serve the same purpose. When you decide to invest in one, the other one is automatically disqualified or abandoned. Now, that is what the examiner is bringing on board. I continue to read. The relevant cash flows of each of the projects are as shown in the table below. Now, you've been given cash flows. I believe you're able to see, and then the cost of capital is given as 15%. Then the cash flows are accruing at the end of the year. We have two projects, Project X and Project Y. I believe you're able to see them. Then we have the initial investment, the amount the investor put in each of these projects. Project X, the investor had put in 38,500. In Project Y, the investor had put in 37,000. Now, cash flows are given for the years year 1 to year number 6. Then the required part is an interesting one. We are being asked, calculate for each project the discounted payback period, and it is 6 marks. Very interesting, huh? And then Roman number 2, you're being asked to compute modified internal rate of return, again another 6 marks. Then the third one, profitability index. Now, because all these are discounting techniques, we're going to cover them and revise the same question using all those techniques because they are the coverage in this part. Now, I want us to look at the discounted payback period. How do you compute it? I told you payback period is the period it takes for a project to recover the investment or the invested amount. How long does it take? And because we are talking about discounted, the cash flows that we're going to test to see at what point we're going to recover our amount that we invested, we're going to use discounted cash flows. And I've told you that when you talk about discounting, there is the discounting factor, which is 1 plus R is negative. And remember, the question has given us the cost of capital, and we already have the period, year number 1 to year number 6. Now, let's see the practical application of it. We already did it, and I want to just give you a very simple way for you to understand it. And remember that whenever you get into this financial management examination, at the back of the paper, you normally get something called discounting tables. But I want to tell you that even if you don't get a discounting table in an exam room, you're able to come up with yours from that, just your calculator. Let me pick my calculator here. So just from your calculator, you are able to compute your discounting factor without a hassle. And again, if you have your computer, you have your Excel. By the way, I will bring on board a question that is talking about project evaluation under the BDA syllabus, Business Data Analytics, and we're going to do it together. Now, remember, this one we are doing on paper, we are writing. But when we are doing BDA, it is on Excel, and I can tell you, when you're computing these things in Excel, it is so simple and so easy, you do not even want to come back and do the writing the way we are doing. But now, because the coverages are different and students are required to compute it physically, this one we have to do it manually on paper. But when doing BDA, in fact, that video is already on my YouTube channel, CPA Samuel Otieno. If you have time, please check through my YouTube channel. You'll be able to pick it because we have lots of videos. There are over 200 videos discussing BDA, advanced Excel, practical accounting, taxation, and all matters surrounding accountancy. Very interesting. You don't want to miss all that. If you are in this line of study, I encourage you to go and like, subscribe so that you don't miss any of this very interesting concept. Now, how do we do this question? Very simple. The examiner gave us the cash flows. And as you can see from what we already did, you just create columns. Column number 1 is for the years. The second column, pick the cash flows the way they've been given by the examiner and list them per year, year number 1 to year number 6. You can already see we have them here. Now, for the discounting factor, I told you, you don't worry even if you're not given the discounting table. And as I give you the two alternatives, I pull down that screen and I put up the discounting table screen. And I believe when I put it up, you will be able to see how you pick it. Let me just show you how do you read that table, because some students do not know how to read the discounting table. Let me show you. Now, here is a discounting table. A discounting table is here. They normally come in different formats, but worry not, it is still the same thing. Now, in this discounting table, how do you pick the figure? One thing you need to pinpoint is the rate of return or the cost of capital. In our case, it was 15%. And then after you pick that, now go to the left column. You see this column where it is written, I believe you can see my cursor, where you have the period given, 1, 2, 3, all the way, and it goes all the way to 25. Then on the horizontal line, you have the percentages. Now, these percentages are the discounting rates or the costs of capital. So you check the year. If it is year number 1, check the cost of capital given, it is 15%. So let's move along the line, along the row of year number 1, up to where 15% is. You see this part? This is where 15% is. Now, that 0.8696 is the discounting factor for year number 1 at 15%. We can confirm the same from the calculator. You don't even have to go to the table. I just put a bracket, open a bracket, 1 plus R. What is R? 15%, 0.15. I close bracket, I raise to power -1. Remember, we are discounting, so that n is negative. So if I do that and I confirm by clicking equal sign, the only thing I'm getting from the calculator is the decimal points are so many. But in our discounting table, it has been rounded off to 4 decimal places. So I will just pick the figure, round it off. It should be the same figure as what I'm seeing in that table. Now, it is 0.869565217. But to put it into 4 decimal places, it will be 0.8696. Is it not the same as what is showing the table? The same. Very nice. So that's how you do it even from your calculator. Now, if you want to go for year number 2, from the table, you can see it is this 1.6257. Now, you do not even have to worry. You do not even have to worry. But then, sorry, we are looking at a wrong table. This table is the present value interest factors for the annuities. I want us to look at the present value interest factor of a single cash flow. Single cash flow. Very good. Yeah, this one here for the single cash flow. Remember, these interest factors we have for annuity, annuity to perpetuity and all that. We're going to discuss all those things as we move forward. So here, look at where 15% is. Though for year number one, it still remains the same even if it's for annuity. But for year number two, it is 0.7561. You can do the same. Now, how you do it in a calculator, you do not start doing everything afresh. All you do, use the navigation key here, go back, and then just change the -1 to -2. In fact, even the negative sign, you don't interfere with it. Just change the figure. So this is -1. I'm just putting 2. Then I confirm by clicking OK. I'm seeing 0.7561436667. Now, to 4 decimal places, 0.7561. Is it not the same? It is the same. So you don't even have to hustle, look at the timetable, the table, the discounted table, if given or not. From your calculator, you have and you'll get the correct thing. Very good. I believe we are together there, and you now understand how we got these discounting factors. And you can see the discounting factors there is 0.8696 for year one, 0.7561 for year two, and all that. Now, the column for present value, we are discounting the cash flows that were given. We are multiplying the discounting factor, which we've already picked, and I've shown you how to get the discounting factor from the discounting table or from your calculator. I will also show you how to do the same on your Excel sheet, which is a very, very interesting concept. You don't want to miss that. Please subscribe, share, and like so that you continue getting all these concepts whenever we post them here. Very good. Now, when you multiply the cash flow by the discounting factor, you get the present value. We are discounting the cash flows. Remember that in the future, you've not done the project. You've been given projected cash flows for year number 1 to year number 6 for project X. And someone is asking you, now, we expect these cash flows to turn out this way for the next 6 years. Now, tell us, between this project A and project B, project X and project Y, like in now our case, which one is viable? So these figures are in the future. You have to discount them because you've not invested. You are just evaluating which one will be viable investment, which one will not be the viable investment. That's why you have to make a decision by discounting first. Now, once you have your present values, remember, we are doing discounted payback period. After you've discounted and you have your present values, you go ahead and now look at what point, which year am I going to recover my investment? And as you do that, the year when you're going to do to recover your investment, do the accumulative figures for the present values. Remember, you are looking at the initial investment, and according to the question paper, if I may drop down this screen and put up where the question was, I believe you are able to see my screen. And if I go to where the question was, you see the initial investment was given. For project X, it is 38,500. That is the amount we're supposed to recover. You ask yourself, how long will it take me when we invest in project X? How long will it take for us to get back our investment of 38,500? That is the question. So for you to be able to get back that amount you've invested, you have now to get the cumulative figures from the discounted present values that you already have. Now, as you do the cumulatives, you compare the cumulatives, which is on the right column, and you say at the end of year one, you were able to recover 21,740. You see that? Then you come to year number two. Year number two, you do the same, multiply the cash flow by the present value interest factor, get your present value. Now, add that present value, whatever figure you have at the end of year one, add to the discounted present value at the end of year two, then you get the cumulative figure. At the end of year two, how much shall you have recovered? 13,422.9. Do the same for year three. How much shall you have recovered at the end of year three? 26,572. Remember, we are looking to recover 38,500. So we haven't recovered it yet. Go to year number four. At the end of year four, you shall have recovered 35,149.9. You are not yet there. You are looking to recover 38,500. Go to year number five and do the same. At the end of year five, you realize that you shall have recovered 38,133. Now, that figure that you shall have recovered at the end of year five is less what you invested, what you are looking to recover. But if you go to year number six, you realize that whatever you're going to recover at the end of year six is more than what you invested. Now, that is the point you need to take very clearly. If you realize that happens, I want you to stop there and now reason and see that actually the amount that you invested, you are going to recover it between year 5 and year 6. So full number of years is 5 years. Then when you come to year number 6, you are just going to recover the small bit, the remaining amount in some number of months in year 6. How do you get it? Get the difference between what you shall have gotten at the end of year 5, which is 38,133.1, from what you are looking to recover, which is 38,500. You realize that you are only less 366.9. Now, in that case, if you are only less 366.9, that is the amount you need to recover in year number 6. Remember, year number 6 is bringing you a cash flow of 2,161.5. But out of that, what you need is only 366.9. That informed the formula of computing the discounted payback period, and you pick the full years, which is 5 years. Then you add the portion or the fraction of that cash flow that you need to recover so that you get back your total investment from the cash flow scenario number 6. And how do you do that? Make sure you convert it again into months. You take the initial investment, the amount you're looking to recover, you deduct lower limit. When you talk about lower limit, it is the amount at year number 5. At the end of year 5, that 38,133 will act as your lower limit. Then you divide that by upper limit minus lower limit. Upper limit is the cash flow in year 6. So you take initial investment, the amount you want to recover in total, subtract the lower limit, which is the amount at the end of year 5. You've not fully recovered what you're looking for, right? Because you are still less 366.9. In fact, the numerator, that difference of 366.9 forms as the numerator of this formula. Then you divide all that by the upper limit, which is the cash flow at the end of year 6, minus the lower limit, which is the cash flow at the end of year 5. Now, when you do that computation, and we did it, and this is what we got, we realized that when you do that computation, the number of months in year 6 that will enable you recover the 366 point, that will enable you to recover the remaining 366.9 is just 2 months. And you can see we got it here, 2.04 months. But because we do not want to go to the number of months, weeks, days, hours, and all that, we just stop at months and we say you're going to recover your investment in 5 years, 2 months. Very good. Ladies and gentlemen, I hope you've gotten something. I hope you've gotten something. If you haven't, I just want to encourage you to go to the bio. These classes, we already posted them. You can review through at your own time. You can adjust the speed. You want to do it faster, you want to do it slow. Again, I want to encourage you to check my YouTube channel, CPA Samuel Otieno. You'll be able to get full videos of these classes. You can watch at your own free time, at a speed that is desirable to you. You can also do the same on your end. And I said, that platform has over 200 videos, our YouTube channel. Again, you can check our Facebook platform, Facebook page. Again, the link to those pages are in this profile, this bio. You can also follow them through the links. Like, subscribe, and share. And as you go through them, you'll be able to be at par. Remember, we have business data analytics lessons, advanced Excel lessons. We've done taxation classes, practical accounting. We've also done a lot of some other videos that are in and around the accounting profession, including consultancy videos. Now, I want you to go there, check through, and you'll be able to understand it best. Thank you so much for your time. I'm CPA Samuel Otieno. In case you need any of these services which I've listed in page 1, you can see we are offering several services. We are doing eTeams integration, and I believe you're aware that Finance Bill 2025 is around the corner. And if you're a business person and you're watching this, or you work in a business, and you know very well that you've not done eTeams integration, and you know the danger is waiting for you, it is your time to make sure that you reach out to us so that we guide you and we help you take care of that menace before the taxman comes for you. You see, we are doing eTeams integration. We are doing eTeams compliant point of sale system. If you don't have one, we can give you one at a very, very pocket-friendly subscription fee, depending on your need. And if you need more information on any of that, we are also still enrolling for May Intake BDA examinations, which are supposed to be done in August for the CPA students who are at post-advanced level. So remember to reach out. Our contacts are 0743 715 645. You can always get them even from the bio, and I can see that we already covered all that. Now, thank you so much for your time, and I hope that you like, you'll share, and you'll subscribe so that you not miss the next one. Thank you so much for your time. Have a good night. Thank you. Bye.